Today, let's talk about a topic related to the Chinese economy. I'm thinking that from now on, every Wednesday, we'll have a regular chat with everyone about economic matters. This is a type of topic that our long-time viewers, who often follow our programme, are particularly fond of. So going forward, we'll make it a regular thing. Every Wednesday, we'll discuss news on the macroeconomic situation in China and the United States, and look at the latest economic data to see what's really happening. Economic conditions and development trends. In addition, we have another series called China Livelihood Chronicles, which, from a social perspective, observes the current economic situation experienced by ordinary Chinese people from a micro-level viewpoint. We all know that the Chinese economy is continuously deteriorating, but how is this reflected in the lives of ordinary Chinese people? Has their daily life actually changed? And if so, in what ways? What kind of lives are they really leading now? This is something we rarely get to see on foreign websites. Yet it is precisely this that concerns us most and best reflects the true state of China's economy. Now, before we begin today's programme, I'd like to ask everyone to do me 3 small favours. First, please give this video a like so that YouTube's algorithm knows this kind of content deserves to be seen by more people. The second is to ask you to help me share this episode. Forward it to your friends and family or post it in your social groups. Every time you share, there's a chance one more person will learn about the real situation in China. And thirdly, please leave your observations in the comments section. If you're in China, have you noticed any changes around you? What exactly have you observed? Every comment could become a clue for our next episode. At this particular moment in history, we need genuine observations, real-life cases and authentic records. And clearly, I can't manage all of this on my own. So I need your participation, my friends, and I look forward to seeing your comments and receiving your emails. I'd like to thank you all in advance. Right, so back to our topic for today. We're going to cover 3 things. First up, on the 11th of this month, Beijing time, China's National Bureau of Statistics released the Consumer Price Index, CPI, and Producer Price Index, PPI figures for January. The CPI rose by 0.2% year-on-year and 0.2% month-on-month. This increase is a clear drop from the 0.8% recorded in December last year, and it's also lower than the market expectation of 0.4%. On the surface, it looks quite good, but what's the real situation? We'll talk about that in a moment. Looking at the PPI, it fell by 1.4% year-on-year, with the rate of decline narrowing by 0.5 percentage points compared to last month's 1.9%. This marks the 40th consecutive month of negative growth. Month-on-month, it rose by 0.4%, with the increase expanding by 0.2 percentage points compared to last month, making it the 4th consecutive month of positive growth. What do these 2 indicators tell us? Let's go through them one by one. The CPI reflects the prices ordinary people pay for goods, and the rate of increase in price levels has dropped compared to the end of last year. This is mainly a reflection of the base effect. What is meant by the base effect? Simply put, it's when you calculate, say, how much prices have risen this year compared to last year. The standard from last year is the base period. If the base period is high, then no matter how much prices rise this year, the year-on-year figure can also easily appear small or low. Conversely, even if there's hardly any increase this year, the year-on-year figure can easily look large. It's just like exam scores. Say last year you scored 98 in your midterm, and this year you scored 92. On the surface, it looks like your performance has dropped, but in fact, both scores are very high. It's just that last year's base was so high, so even a slight dip this year makes it seem as though your performance has declined. It's the same principle. Specifically, when it comes to the CPI figures, in January 2025, which happened to coincide with Chinese New Year, the overall level of consumption within China was particularly lively. Everyone was celebrating the New Year, buying groceries, eating out, travelling, purchasing gifts, food and services, so prices shot up especially high. So what about the prices that month? Well, because of the timing of Chinese New Year, demand was pushed up very high, which meant that the base figure for January last year was especially high. Now, this January, although it's nearly New Year again, the actual New Year doesn't arrive until February. In January, the New Year peak hadn't yet arrived, so compared to January last year, the prices of food and services were much lower. So if you compare this January's figures, which have a low base, with last year's high base figures, of course the year-on-year increase appears smaller, and it even looks as though there's hardly been any rise at all. This is the base effect at play. It's not that things are actually cheaper this year, but rather that prices were too high during the same period last year, which has raised the bar for comparison. Aside from this factor, international oil prices have also dropped quite a bit recently, which is dragging the overall CPI down as well. If you look at the CPI figures over a longer period, you'll be able to spot the problem. China's CPI data has remained at a low level for several consecutive years. From 2023 to 2026, the annual average level is between 0.5% and 0.9%, which is far below the healthy inflation rate of 2%. It's similar to the period from 2015 to 2016, when China experienced the cycle of overcapacity, as well as the low inflation seen during the post-pandemic recovery. But this time, the duration is much longer than the previous two occasions. For the vast majority of ordinary economies and ordinary people, a moderate rise in CPI, roughly between 1% and 3%, is the ideal state. Too high or too low is not ideal. However, at present, China's CPI has been hovering around the 0.5% mark for a long period. For the past 4 years, it has remained at a low level. When CPI is too low, or even close to 0%, it is actually a very bad sign, because people expect things to keep getting cheaper, which makes them even less willing to spend money. Of course, people just wait and see, thinking, oh, I'll buy it when the price drops a bit more, which leads to further contraction in consumption. This affects businesses as they can't sell their goods, so inventories pile up and profits are squeezed significantly. As a result, companies don't dare to raise wages. They don't dare to invest and may even lay off staff, which then leads to increased unemployment, and so the vicious cycle begins. The actual burden of debt, that becomes heavier as well. Although the amount owed hasn't depreciated, incomes and assets aren't increasing. They might even fall, which makes the pressure to repay debts even greater. If the CPI is too low, it indicates that demand is seriously lacking and the economy is starved of oxygen. If this continues for a long time, it will fall into a deflationary trap. Clearly, China is already in this situation now. In the midst of a deflationary cycle when it comes to prices and saving money, for us ordinary people in the current economic climate, sometimes we really do have to scrimp and save to get by. The CPI I just mentioned refers to the prices ordinary people pay for goods, while the prices at which businesses sell goods are measured by the PPI. This figure can reflect even more clearly just how severe the current deflationary pressure is in China. It refers to the factory gate price, that is, the price changes of industrial goods at the wholesale stage. If the prices at which businesses sell things keep falling over a long period, it means there's simply too much of the stuff it's not selling, or buyers are offering lower prices. Prices are being pushed down very low, and this directly exposes the issue. China is currently experiencing an imbalance between supply and demand. Similarly, if we look at the PPI data over a longer period, China's PPI has now been in decline for 40 consecutive months. It has been negative growth. Starting from October 2022, it has remained at minus 1.4% up to now. This is the longest continuous period of negative growth on record. By comparison, from 2012 to 2016, there was also a period of overcapacity, and although the PPI fell sharply then as well, the duration and severity were nowhere near as great as this time. This time, from the end of 2022 right up to now, it has been falling almost without ever turning positive. Why has the PPI dropped so severely? It's mainly because it's being squeezed from both ends, with pressure concentrated on one side. If an oversupply issue on the supply side, China's manufacturing capacity is particularly excessive. In many industries, such as steel and new energy vehicles, over the past few years, growth has relied heavily on subsidies, with government support and investment expanding far too aggressively. Now, factory operating rates have plummeted, and the products manufactured are piling up in warehouses. Not long ago, we were still talking about how China's steel mills were shutting down en masse. This is extremely rare. According to the latest data, in 2025, that is last year, the average industrial capacity utilisation rate for the whole year was only 74.4%. In the fourth quarter, it was 74.9%, which is 0.6 percentage points lower than a few years ago. That's quite a bit below a healthy normal level. For it to be considered healthy, the rate needs to be around 80% or even higher to be regarded as saturated. A low capacity utilisation rate means that many machines are sitting idle. However, in order to maintain cash flow, companies are forced to offload goods at low prices, which in turn pushes prices down even further. This is one side of the issue. On the other side, there's the demand side. Demand is weak, domestic consumption and investment haven't kept up, people don't dare to spend large sums on purchases, and companies are seeing orders fall and profit margins shrink. So they don't dare to expand production or raise prices. The result is that the prices of industrial goods can't be passed on to the PPI, so it remains persistently low. On a month-on-month basis, there has been positive growth for 4 consecutive months recently, which is a small bright spot. This indicates that in the short term, some industries, such as the non-ferrous metals sector, which has recently been driven by global prices, are seeing prices rebound, and the decline in some raw material prices has halted. However, year on year, the figures are still negative. This shows that the overall structural issues have not been resolved. These minor rebounds are merely individual industries being affected by the international market, unable to catch their breath for a moment. However, the root causes of deflation in China, such as excess production capacity and weak demand, remain deeply entrenched. Speaking of this, I'd like to ask everyone, whether you're in China or abroad, what is the economic environment like where you are now? Have you noticed that things are getting cheaper and cheaper, but at the same time it's becoming harder and harder to make money? For example, you might have noticed that there are more and more discounts in supermarkets, but your salary hasn't increased for years. Or if you run a business, you might have found that your peers are all engaged in price wars and profit margins are getting thinner and thinner. If you've noticed things like this or have any other observations, please leave a comment below and let me know. That way, we can all compare notes and see how people are feeling about the current economic environment in China versus overseas. How big's the difference? So the issues shown by the CPI and PPI data, just released in January, indicate that China is sinking further into the quagmire of deflation, with domestic demand remaining persistently weak. The longer this situation continues, the more dangerous it becomes. So this has forced the government, well, they've got no choice but to step in. This brings us to the second topic we're going to discuss today, which is that during the Chinese New Year, the Chinese Communist Party government decided to hand out large sums of money to stimulate consumption. Also today, Shang Chuping, the Vice Minister of Commerce, announced that during this year's 9-day Chinese New Year holiday, local governments across the country have allocated a total of 2.05 billion yen. This will be distributed through consumer vouchers, subsidies, red envelopes and so on. Yes, this money will go directly into the hands of ordinary people with the aim of boosting consumption and encouraging everyone to spend more. It all sounds rather lively, doesn't it? In fact, this is the policy set by the Chinese Communist Party at the opening meeting of the 15th five-year plan, with the aim of stimulating domestic demand and building up the domestic market. Now, they're not just handing out money, they've also joined forces with 9 departments to launch a special event called 2026 Happy Shopping Spring Festival. This covers the entire chain, from food, accommodation, travel, transport, shopping to entertainment. For example, they're introducing things like encouraging people to travel by following film locations, organising temple fairs, intangible cultural heritage performances, and rural New Year's markets, all with various subsidies. In 50 pilot cities, they're running a prize draw receipt scheme, which basically means giving money directly to the public. Issuing receipts and vouchers to stimulate consumption. And what about the various regions? Now, they're also talking about integrating resources and rolling out a series of measures to benefit the public, such as Shanghai's Shop in China, celebrate the new spring shopping season, and so on. A whole host of initiatives. In short, they're racking their brains to get everyone moving during the Chinese New Year period, encouraging more spending and more shopping. At first glance, this all sounds rather good, doesn't it? The Chinese Communist Party has finally come round and is willing to hand out money. Great! Apart from wondering whether I'll be able to get any myself. Just joking. What I'm also concerned about is how much of an impact this money can actually have on the current state of China's economy. We really need to compare things with the past to see what's actually going on. First of all, has there ever been a similar stimulus before? And as for this time, how does the scale of this stimulus compare to previous ones? That way we can predict what sort of effect it might have this time. Now, this isn't the first time the Chinese Communist Party has done something like this. There have been plenty of similar moves in the past. For example, after the global financial crisis in 2008, China didn't issue large-scale consumer vouchers at the time. However, at the local level, they had already tested the waters with small-scale subsidies to stimulate demand. The real nationwide large-scale rollout by the Chinese Communist Party happened during the pandemic in 2020, when the economy had come to a standstill. Retail sales plummeted by 15.8% due to the lockdowns, so the government authorised local authorities to issue digital consumer vouchers to rescue the market. By April 2020, there were already 16 provinces and nearly 50 cities involved. At the time, all sorts of consumer vouchers were issued to be used for dining, shopping, tourism and so on. The total scale was dispersed, but cumulatively it reached at least several tens of billions of RMB. For example, the city of Hangzhou alone issued nearly 1.7 billion yuan. Nanjing issued 1 billion. These consumer vouchers were distributed via platforms like Alipay and WeChat, with low thresholds and strong targeting, and in the short term they did indeed boost catering and retail. But what about the actual results? Well, research shows, according to the Chinese Communist Party's own studies, that every 1 yen of government spending could stimulate between 3.1 and 3.3 yen of additional consumption. Admittedly, this multiplier effect looks quite decent, but it only spurred a short-term rebound, and very soon consumption weakened again. Moreover, there are actually a great many problems with this. What sort of problems, you ask? Well, they're typically Chinese Communist Party issues. For example, in 2023, an audit report was carried out on these consumption vouchers, and the findings were rather painful to read. In places like Guangdong and Shandong, these consumption vouchers were completely misused. Due to chaotic management, the actual expenditure was pitifully low. For instance, in some counties in Shandong, the budget allocated was 10,000 yuan, but how much did they actually spend? Friends, just think about it for a moment. Imagine a budget of 10,000 yuan being distributed to ordinary people. How much do you reckon actually reached them? Well, it was less than a tenth, only 935 yen. Not even a tenth, just think about that. And what's more, this 935 yuan was only spent at 3 businesses, so it really didn't have any effect at all. Don't forget, this is the Chinese Communist government we're talking about. Any money distributed from above just gets absorbed by the system, embezzled straight away. As soon as the money's allocated, it gets blocked at every level, and in the end, hardly any of it is actually spent. It just fizzles out and comes to nothing. It's a waste, a complete waste. On the surface, it looks like money's been handed out, but in reality, it all ends up in the pockets of Communist Party officials. This is the Chinese Communist Party's trademark, isn't it? You can see it coming a mile off. So, as for how much it actually stimulates the economy, well, that's obvious. It's self-evident, really, so let's not be too sarcastic about it. Everyone knows the score. Also, between 2024 and 2025, the Chinese Communist Party has rolled out another scheme to replace old goods with new ones, which is another massive subsidy policy. In 2024, they handed out 150 billion yuan, and in 2025, that figure doubled to 300 billion, mainly targeting household appliances, cars and electronic products. Yet in the end, it failed to make any real impact. Throughout 2025, the core CPI remained flat, with the CPI rising by only 0.7%. You see, even after throwing 300 billion yuan at this trade-in subsidy, prices barely moved at all. The reason there was no improvement, why is that? Is because firstly, these subsidies only boosted sales of specific products and didn't translate into overall demand, so the demand side across China simply wasn't lifted. Furthermore, the essence of this trade-in scheme is actually just to cut prices in exchange for sales volume. This approach is being used to address the issue of overcapacity in Chinese industry. Moreover, it brings forward demand. In other words, the general public might not actually need to replace their goods right now, but with the introduction of this trade-in scheme, they think, oh, well, I might as well replace it early. After they've replaced it early, this year's base number, the base effect we mentioned earlier, becomes extremely high. Once this batch has been replaced, the following year, because of this high threshold, demand will immediately drop off. That's exactly what happens in reality. So what it really addresses is the issue of overcapacity in Chinese manufacturing. The subsidies merely act as a stopgap, allowing sales in the home appliance sector to look a bit better in the short term. Fundamentally, they haven't tackled the core issue of stimulating demand at all. But even with this 300 billion yuan stimulus, you can see that it hasn't managed to lift the CPI out of its long-term slump, nor has it enabled the PPI to achieve even a single month of positive growth. So what effect can the 20 billion just announced by China for the new year really have? No matter how much more subsidies given, at the end of the day, it's just boosting the numbers. Let's put it this way. Let's make the most unlikely assumption. Suppose this time the entire subsidy goes through. No corruption, not a penny embezzled. Every bit of it is handed out. Well, this 9-day, 20 billion yuan New Year package is at best just a bit of a tickle. Its scale is far smaller than the previous 2 rounds, and the stimulus is even more limited. Sooner or later, the truth will come out. In terms of scale, it's nowhere near last year's 300 billion yuan subsidy for trade-in schemes, let alone the scale of the consumer vouchers distributed across China during the pandemic in 2020. Back then, they were spread out across various regions, but the total reached several tens of billions of yuan. So this 20 billion is just a drop in the ocean. The current state of China's economy is rather like a patient with a serious wound. Due to overcapacity, it's desperately exporting at low prices. Alternatively, domestically, it's relying on trade-in schemes to absorb the surplus internally, with government subsidies acting like a hemostatic medicine. They can temporarily stabilise things, but the root of the wound is the weakness of domestic demand, which hasn't been addressed or stitched up. Sooner or later, it's bound to start bleeding again. To truly heal, one must start by expanding genuine domestic demand and adjusting the structure of production capacity rather than always relying on subsidies to keep things going. This dependence on subsidies doesn't solve the problem of domestic demand. On the contrary, it makes China's economy even more reliant on exports, thereby widening the trade imbalance. And so we come to our third key point today. The Chinese Communist Party has announced that the trade surplus for 2025 has reached a historic record of $1.189 trillion. Behind this impressive figure, in reality, lies the helplessness of export dumping. Let's take a look at what the data actually says. According to the annual foreign trade report released by the General Administration of Customs on the 14th of January, the total export value was $3.8 trillion. That's a year-on-year increase of 5.5%. And what about imports? They stood at 2.58 trillion, which basically didn't change. As a result, the trade surplus soared to 1.189 trillion, an increase of as much as 20% compared to 2024. Previously, we did a programme on this topic. At that time, the data for the final month wasn't available yet. It was just the figures for the first 11 months. Even then, the surplus had already reached 1 trillion. We said back then that this was an astonishing figure, absolutely unprecedented in the entire history of Western countries. It absolutely stunned the Western media. For China to achieve such results under the heavy tariffs imposed by Trump, it's simply incredible. Absolutely top marks. But then, how did this record-breaking trade surplus come about? We've talked about this before, we've analysed this issue. For those who missed it, I strongly recommend you go and have a look. Here, I'll just share the conclusion with you directly. The calculation of the trade surplus is actually closely linked to the exchange rate. Now, the current exchange rate of 7 yuan to $1 actually seriously undervalues the yuan by about 40% to 50%. This is calculated according to purchasing power parity, or PPP. The actual exchange rate between the yuan and the US dollar should be about 1 to 3.4 or 3.5. What does that mean? It means that, in effect, the Chinese Communist Party is doing business with the world using a yuan that's been halved in value. Just think about it. Your goods are actually worth 100 quid, but you price them at 50 and sell them. Of course you'll get more orders, and naturally the surplus will be bigger. So, of the $1 trillion trade surplus that the CCP boasts about, nearly a third of it is actually inflated by the artificially weak yuan. If you take away this inflated portion, the real trade surplus at the genuine market exchange rate is only about 650 to 750 billion. How exactly is this figure calculated? What is the actual relationship here? I suggest you watch that episode. I've put it in the card at the top right corner. In other words, of the CCP's record-breaking 1.189 trillion trade surplus, once you remove the inflated portion, the real surplus is only about 800 billion. Apart from this exchange rate inflation, there's an even more fundamental issue, which is exactly the same trick as the domestic trade-in for new scheme. Abroad, they're also using the low price for sales volume model. Why is that? Quite simply, domestic demand can't pick up. There's a severe overcapacity problem, and the goods churned out by factories running at full tilt can't be absorbed at home. So what do? They sell them cheaply and dump them abroad. What do these two aspects reveal? They show that the CCP's record-breaking trade surplus isn't achieved through genuine strength, but is actually a symptom of deeper problems spilling over. Excess domestic capacity combined with weak demand, then dumping products abroad by undervaluing the exchange rate, and on top of that, inflating the figures. And just like that, yet again, they've broken another record. So let's consider 3 key points: China's long-term high CPI, 40 months of PPI deflation, and the New Year's 2.05 billion yuan vouchers are just a temporary fix. But what's the root cause? Judging by the scale of previous years, it's nothing remarkable at all, hardly enough to provide any real stimulus. And then there's the record trade surplus of 1.189 trillion yuan. When you piece all these figures together, what emerges is a bleak picture of China's economy, one that is grotesquely dependent on certain factors. On the surface, the figures look impressive, but what's underneath? It's already like an old lorry leaking oil, just about managing to inch forward thanks to exports and subsidies. But the engine of domestic demand is broken, and after 4 years it still can't be fixed. Now, the globally renowned geopolitical risk consultancy, Eurasia Group, has released its 2026 Global Top 10 Risks report this year. Every year they publish a list of the top 10 global risks at the start of the year, and in this year's report, China's deflationary trap has been directly listed as the world's 7th biggest risk. The Wall Street Journal has gone even further, publishing an article with the headline, "Deflationary Death Spiral Traps China's Economy." China's deflation is not a short-term phenomenon. Those of you who have been following our programme for some time may recall that we have been saying for quite a while now that China is in a state of deflation, and the longer this situation persists, the more dangerous it becomes. This is a vicious cycle caused by structural problems and policy mistakes by the Chinese Communist Party. If things carry on like this, the next step will be China experiencing its own lost 30 years like Japan, and it could well be even more severe than what Japan went through. Why is that? Because at least Japan still had the foundations of a developed country and a social welfare safety net at the time. So, what does China have? What do you think? So this really is a very sobering sign, extremely alarming in fact. That's why today we're sharing this topic with you all. If you've enjoyed it, please remember to give me a like, and if you like this sort of content, do leave a comment and share your thoughts with me.